In 1991, regulators shut down a global bank operating across nearly 80 countries. The institution handled billions of dollars in deposits. Government officials used its services. Intelligence agencies maintained accounts within its network. Wealthy clients trusted it to move money across continents. Behind the operation was a global banking scam built on shell companies, hidden losses, and secret accounts. The bank operated through a complex structure of subsidiaries and offshore entities. Its headquarters were spread across multiple jurisdictions. No single regulator had full authority over its operations. Supervisory responsibility was divided between countries. For years, the bank continued expanding across Asia, the Middle East, Europe, and Africa. Investigators eventually began comparing records across several jurisdictions. The structure that enabled the expansion also concealed the fraud. This was BCCI, a global banking scam that exposed the limits of fragmented financial oversight. The Bank of Credit and Commerce International was founded in 1972. The founder was Pakistani banker Aga Hassan Abadi. Abadi had previously worked at United Bank Limited in Pakistan. He believed traditional Western banks ignored emerging markets. His vision was to build a global bank serving developing economies. The institution would operate across Asia, the Middle East, Africa, and Latin America. Abadi promoted the idea of a bank designed for international commerce between developing states. The concept attracted investors from several countries. Early financial backing came from wealthy Gulf investors. One of the largest shareholders became the ruler of Abu Dhabi, Sheikh Zayed bin Sultan Al Nahyan. The bank established its early headquarters in Luxembourg. Another major operating center was created in London. From the beginning, BCCI positioned itself as a multinational institution. Its strategy focused on countries where Western banks had limited presence. Branches opened rapidly across the Middle East. Expansion continued into South Asia and Africa. The bank also opened offices in Europe and North America. Within a few years, BCCI had become one of the fastest expanding banks in the world. Executives emphasized international connectivity as the bank's central strength. The institution marketed itself as a bridge between financial systems. By the late 1970s, BCCI operated in dozens of countries. Each new branch increased the bank's global presence. Deposits began growing quickly as new markets were added. The bank attracted clients who needed cross-border financial services. Many customers came from regions underserved by large Western banks. Abadi personally promoted the bank's international mission. He traveled extensively to cultivate political and financial relationships. These relationships helped BCCI gain access to new markets. The bank often entered jurisdictions where regulatory systems were still developing. This environment allowed the institution to expand with fewer constraints. Branches sometimes opened faster than regulators could fully evaluate them. The bank's structure began spreading across multiple financial centers. Different offices performed different operational roles. Some handled deposits. Others processed international transactions. Corporate leadership remained concentrated among a small group of executives. Decision-making often occurred across several countries simultaneously. Rapid expansion became the defining characteristic of the institution. By the early 1980s, BCCI had offices in dozens of financial jurisdictions. Its global footprint continued increasing every year. The bank's leadership celebrated growth as proof of success. However, rapid international expansion also created operational complexity. Oversight across multiple jurisdictions became difficult. Supervisors in individual countries only saw part of the organization. The global structure expanded faster than regulatory coordination. Rapid expansion limits oversight. From the beginning, BCCI was structured as a multinational institution. Unlike traditional banks, it did not operate under a single national regulator. Instead, The bank distributed its legal identity across multiple jurisdictions. One major holding company was registered in Luxembourg. Another important entity was incorporated in the Cayman Islands. These locations offered favorable financial regulations and international banking frameworks. The structure allowed BCCI to operate across borders with relative flexibility. Branches could open in different countries under separate legal entities. This arrangement reduced the authority of any single regulator. Each supervisory agency monitored only the portion within its jurisdiction. No authority had full visibility over the entire banking network. This fragmentation created an unusual regulatory environment. Financial information was distributed across multiple reporting systems. Regulators often depended on cooperation from other jurisdictions. However, international regulatory coordination was limited during the 1970s and 1980s. Information sharing between authorities remained inconsistent. BCCI used this environment to build a complex organizational structure. The bank divided operations between separate corporate entities. Some subsidiaries held deposits. Others managed international transactions. Certain units handled investment activities. This distribution blurred the boundaries between banking functions. Financial oversight became fragmented across several regulatory agencies. Each authority reviewed different balance sheets and reports. The full structure remained difficult to reconstruct from any single set of records. Corporate ownership was also layered through multiple holding companies. This structure complicated efforts to determine ultimate control of the institution. Internal transactions moved between subsidiaries in different countries. Funds could travel through several jurisdictions before reaching their destination. These transfers made it harder for regulators to track financial flows. The bank's management argued that this structure reflected its global business model. Executives described the bank as a decentralized international institution. However, the distributed structure also reduced transparency. Regulators relied on partial information from separate jurisdictions. This limited their ability to detect systemic risks within the organization. Each country assumed other regulators were monitoring additional parts of the bank. Supervision became divided across continents. BCCI continued expanding while operating under fragmented oversight. The institution effectively existed across multiple legal environments at once. Jurisdiction determines accountability. As BCCI expanded across continents, its internal structure became increasingly complex. The banks did not operate as a single unified corporation. Instead, it was divided into dozens of subsidiaries and affiliated companies. Many of these entities were registered in offshore financial centers. These locations included the Cayman Islands and other low-transparency jurisdictions. Each subsidiary maintained separate legal and financial records. Ownership of some entities was layered through additional holding companies. This structure created multiple levels between operations and ultimate control. Funds could move between these entities through internal transactions. Transfers often passed through several subsidiaries before reaching final accounts. The system allowed large volumes of money to circulate within the organization. Internal accounting records became difficult for outsiders to interpret. Regulators reviewing a single subsidiary could only see a fragment of the structure. The complete financial picture required information from multiple jurisdictions. That information was rarely consolidated under one regulatory authority. Complex internal transfers created distance between deposits and reported balances. Some transactions appeared as intercompany loans. Others were recorded as internal investments. These entries moved funds between related entities without leaving the organization. The layered system increased operational opacity. External observers struggled to determine which entity held specific assets. Ownership records were often distributed across several legal documents. Corporate filings in one jurisdiction referenced companies registered elsewhere. This fragmentation made verification more complicated. Auditors reviewing financial statements relied heavily on internal documentation. Direct confirmation of transactions sometimes required cooperation across multiple countries. International legal boundaries slowed the verification process. Each jurisdiction maintained different disclosure requirements. Some subsidiaries operated in regions with limited financial transparency rules. These conditions allowed the bank to maintain confidential account structures. Certain clients valued secrecy as a financial service. Private banking relationships were often handled through specialized branches. Accounts could be managed through multiple affiliated entities. The structure provided flexibility for international financial transfers. However, it also reduced the visibility of underlying financial positions. Internal financial flows became increasingly difficult to trace. The organization functioned through overlapping corporate layers. Decision-making remained concentrated among a small leadership group. External stakeholders often relied on summaries rather than detailed internal data. Over time, the structure became a defining feature of the bank's operations. Complexity shields risk. BCCI expanded during the late 1970s and early 1980s. The bank cultivated relationships with influential figures. These relationships extended across governments, financial institutions, and international organizations. Senior executives frequently met political leaders in countries where the bank operated. Such relationships helped the institution gain access to new markets. Banking licenses in developing countries often depended on political approval. BCCI leadership understood the value of maintaining close political connections. The bank also attracted clients who required confidential financial services. These clients included politically exposed individuals. Private banking services allowed funds to move through international accounts. BCCI's global branch network made these transfers easier. Accounts could be opened in one country and managed from another. Financial services often crossed multiple jurisdictions simultaneously. This flexibility attracted clients seeking discretion in financial transactions. The bank developed a reputation for accommodating sensitive accounts. Some accounts were associated with political organizations. Others were linked to state institutions. The bank's secrecy policies limited public visibility into client relationships. Bank officials argued that confidentiality was a standard feature of private banking. However, the structure also created an environment where financial scrutiny was limited. Certain transactions were handled through internal channels rather than public markets. The bank's leadership emphasized trust and discretion as core services. These qualities attracted powerful clients. Powerful clients, in turn, reinforced the bank's credibility. The presence of influential customers reduced external skepticism. Criticism of the bank could carry diplomatic implications. Investigations into politically connected accounts became sensitive matters. Regulators sometimes approached the bank cautiously. The international nature of the institution complicated enforcement. Authorities in one jurisdiction rarely possessed full access to accounts held elsewhere. Political influence also affected how financial concerns were addressed. Certain governments viewed the bank as strategically important. The institution facilitated financial flows across regions with limited banking infrastructure. This role strengthened its political relationships. Executives continued expanding the client base across several continents. Relationships with powerful clients helped sustain rapid growth. These connections also discouraged aggressive regulatory scrutiny. When financial institutions serve influential networks, oversight may weaken. Political relationships can shield institutions from immediate examination. Power deters scrutiny. By the early 1980s, BCCI had expanded across dozens of countries. Rapid growth placed increasing pressure on the bank's financial structure. Large volumes of deposits required careful asset management. However, internal lending practices began creating hidden risks. Some loans were issued to companies connected to the bank's own insiders. These transactions blurred the line between external lending and internal financing. Funds were sometimes routed through affiliated entities. Loans were occasionally extended without traditional collateral requirements. In some cases, the borrowers were unable to repay the obligations. These non-performing loans created losses inside the bank's balance sheets. Rather than immediately reporting the losses, internal transfers were sometimes used to conceal them. Funds moved between subsidiaries to offset financial gaps. Accounting entries shifted liabilities between different corporate entities. These movements made losses less visible within individual reports. The bank's complex structure allowed these adjustments to occur across jurisdictions. Supervisors reviewing local subsidiaries often saw only partial financial data. The underlying financial exposure became distributed across multiple branches. Certain loans were routed through shell companies connected to insiders. These shell entities borrowed funds and redirected them through internal channels. The transactions obscured the origin and destination of the funds. In effect, internal losses were being recycled through the bank's own network. Executives continued reporting strong growth despite these emerging financial gaps. Deposits kept increasing across international branches. This influx of new funds temporarily supported the institution's liquidity. However, the underlying financial imbalance continued growing. The bank relied increasingly on internal transactions to maintain stability. The accounting structure delayed recognition of the losses. Auditors and regulators struggled to track these movements across subsidiaries. Documentation often appeared legitimate when examined in isolation, but the broader pattern remained difficult to identify. The structure allowed losses to circulate inside the organization. As long as deposits continued growing, the system remained operational. However, the financial exposure accumulated over time. Eventually, the hidden losses reached levels that could not be contained. Internal financial adjustments could delay recognition but not eliminate risk. When financial losses remain concealed, the underlying exposure expands. Losses delayed increase exposure. As BCCI expanded across dozens of jurisdictions, auditors began encountering unusual verification challenges. The bank's internal records were distributed across many subsidiaries. Financial transactions often moved through several affiliated entities before reaching final accounts. Tracing the origin and destination of funds became increasingly complicated. Auditors reviewing individual branches could only access local financial records. The broader network of transactions often extended beyond their jurisdiction. Verification required cooperation between regulators and auditors in different countries. During the 1980s, international regulatory coordination remained limited. Information sharing between authorities was slow and inconsistent. This environment complicated efforts to evaluate the bank's global balance sheet. Auditors occasionally raised questions regarding the complexity of the structure. Internal documentation sometimes referenced transactions involving distant subsidiaries. Confirming those transactions required records from multiple jurisdictions. Legal restrictions occasionally prevented regulators from sharing confidential banking data. These barriers slowed investigative efforts. Some supervisory agencies began issuing warnings about the bank's internal practices. However, the warnings often remained limited to individual regulatory reports. No single authority possessed the full picture of the organization. BCCI continued operating across its global network. Branches remained active in Asia, Europe, Africa, and the Middle East. Deposits continued flowing into the bank from international clients. The institution still appeared financially stable in public disclosures. Auditors sometimes struggled to verify certain asset positions. Certain internal transactions lacked complete supporting documentation. Requests for additional records could take months to process. Cross-border legal processes slowed the exchange of financial evidence. The bank's distributed structure created procedural delays. Each jurisdiction maintained different regulatory standards. Some regulators applied stricter oversight than others. These differences created uneven supervision across the network. Investigations into specific transactions often stalled at national boundaries. Authorities reviewing local records could not easily access international data. The bank's leadership continued emphasizing its multinational identity. Executives described the structure as necessary for global banking operations. However, the same structure limited effective oversight. Auditors could review parts of the system, but not the entire network. Regulators encountered the same limitation. Each authority examined only the segment within its territory. The institution effectively operated between regulatory systems. Without coordination, warnings remained fragmented. The bank continued functioning despite growing supervisory concern. Oversight without coordination fails. By the late 1980s, concerns about BCCI began attracting wider attention. Regulators in several countries had already raised internal warnings. However, these warnings remained scattered across separate jurisdictions. No single investigation yet connected the full structure of the bank. During this period, journalists and financial investigators began examining the institution more closely. Reports emerged questioning the transparency of BCCI's operations. Some analysts noticed inconsistencies in the bank's financial disclosures. Questions also appeared regarding the ownership structure of certain subsidiaries. In the United States, regulators began monitoring BCCI's activities more closely. American authorities had concerns about the bank's involvement in domestic financial markets. Investigators started reviewing the bank's relationships with U.S. financial institutions. One major concern involved the bank's indirect control of other banking entities. These arrangements allowed BCCI to access markets where direct ownership might have triggered regulatory scrutiny. Investigators examined how the bank structured these relationships. At the same time, media investigations began highlighting irregularities within the institution. Financial reporters examined corporate filings and regulatory documents. The investigations suggested that the bank's structure concealed unusual financial practices. These findings increased pressure on supervisory authorities. Regulators in several countries began sharing information more actively. The U.S. Senate also opened inquiries related to international banking activities. These hearings examined financial institutions operating across multiple jurisdictions. Witness testimony raised further questions about BCCI's internal controls. Investigators focused on the bank's complex ownership structure. Evidence suggested that key financial decisions were concentrated among a small group of executives. This concentration of control raised additional concerns. Regulators attempted to determine whether internal fraud had occurred. However, gathering evidence across multiple countries proved difficult. Legal procedures varied between jurisdictions. Financial records were distributed across different regulatory systems. Obtaining documentation required cooperation from foreign authorities. The process slowed investigative progress. Despite the challenges, investigators gradually assembled a clearer picture. Separate reports began identifying similar irregularities. Patterns emerged in the bank's lending practices and internal transfers. Investigators concluded that the institution's structure concealed systemic problems. The investigations expanded into several countries. Regulators and prosecutors began coordinating their inquiries. After years of fragmented warnings, the first coordinated investigations began taking shape. Exposure requires persistence. By 1990, investigations into BCCI had expanded across several countries. Regulators in the United States, the United Kingdom, and other jurisdictions began sharing information. Separate inquiries started revealing overlapping financial irregularities. Evidence suggested that the bank's problems were not isolated incidents. Instead, they pointed to systemic fraud within the institution. Investigators discovered large volumes of undocumented transactions. Some financial records appeared inconsistent with reported balances. Internal loans had been routed through multiple subsidiaries. These transactions concealed losses inside the bank's network. Authorities gradually recognized that the bank's problems extended across its entire structure. The scale of the irregularities raised concerns about the bank's solvency. Supervisors began considering coordinated regulatory action. During early 1991, investigators compared records across several jurisdictions. The results confirmed that major financial gaps existed inside the bank. These findings triggered discussions between international regulators. Authorities realized that unilateral action by a single country would be ineffective. The bank operated simultaneously across dozens of jurisdictions. Coordinated intervention became necessary. In July 1991, regulators initiated a global response. Authorities in several countries moved to freeze the bank's assets. Supervisors suspended operations in key financial centers. The actions occurred almost simultaneously across multiple jurisdictions. Bank branches began closing across Europe, the Middle East, and Asia. Customers arriving at branches discovered that accounts were frozen. Depositors attempted to withdraw funds. However, many accounts were no longer accessible. News of the shutdown spread rapidly through financial markets. Confidence in the institution disappeared almost immediately. Panic spread among depositors and business clients. Regulators placed the bank into liquidation proceedings. Thousands of employees were affected by the sudden closure. Governments attempted to evaluate the scale of financial losses. The bank's global network had handled billions of dollars in deposits. However, large portions of those funds could not be fully accounted for. The collapse shocked international banking regulators. The case demonstrated the vulnerability of fragmented oversight systems. A bank that operated across 78 countries had collapsed within days. Once regulators coordinated their actions, the institution could no longer continue operating. Confidence collapsed instantly. The shutdown of BCCI in 1991 created immediate financial consequences across several countries. The bank had operated in 78 jurisdictions. Millions of depositors held accounts within its global network. Many customers depended on the bank for international financial services. When operations stopped, access to funds was suddenly restricted. Depositors attempted to withdraw their balances. However, large portions of the bank's assets were frozen during liquidation. Regulators began evaluating the scale of financial damage. Early estimates suggested billions of dollars in losses. Some deposits were partially protected through national compensation systems. Other customers faced long delays while liquidation proceedings continued. Small businesses that relied on the bank experienced immediate disruption. International trade payments were interrupted. Several governments began reviewing how the bank had expanded within their financial systems. Parliamentary inquiries opened in multiple countries. These investigations examined how regulators had supervised the institution. The findings revealed significant gaps in oversight coordination. No single authority had monitored the entire organization. Supervisors in individual countries had only limited information. This fragmentation allowed the bank to expand despite internal financial problems. The scale of the collapse raised concerns about international banking supervision. Policy discussions began regarding cross-border regulatory cooperation. Financial institutions operating globally required stronger oversight frameworks. Governments examined whether international standards should be strengthened. The case influenced future banking regulation discussions. Supervisory agencies recognized the importance of coordinated oversight. The collapse also created political consequences. Officials faced questions regarding their earlier supervision decisions. Public inquiries evaluated whether warning signs had been overlooked. Media investigations continued examining the bank's operations. Reports described the institution as one of the largest banking frauds in history. The scale of financial exposure surprised many regulators. Depositors in multiple countries waited years for partial recovery of their funds. Liquidation proceedings continued through complex legal processes. International asset recovery required cooperation across several jurisdictions. These procedures demonstrated the difficulty of resolving global banking failures. Financial losses multiplied because of the bank's geographic scale. A bank operating across 78 countries had created worldwide exposure. When such institutions fail, consequences extend far beyond a single market. Scale multiplies damage. After the shutdown of BCCI in 1991, governments and regulators began pursuing legal action. Investigations expanded across several jurisdictions. Authorities attempted to determine responsibility for the bank's collapse. Regulators reviewed internal records and financial documents recovered from the bank. Evidence suggested that fraudulent practices had occurred over many years. Investigators focused on senior executives who directed the bank's operations. Aga Hassan Abedi, the bank's founder, became a central figure in the inquiries. Abedi had led the institution since its founding in 1972. However, his health declined during the early stages of the investigation. Legal proceedings against him became complicated by medical considerations. Authorities in multiple countries also examined the actions of other executives. Some senior managers faced criminal charges related to fraud and financial misconduct. Prosecutors attempted to trace the movement of funds through the bank's subsidiaries. The process required cooperation between regulators in different countries. International legal assistance agreements supported these investigations. However, complex corporate structures slowed the legal process. Financial records were dispersed across multiple jurisdictions. Investigators needed access to documents held in different regulatory systems. Some assets connected to the bank were frozen during legal proceedings. Authorities attempted to recover funds for depositors and creditors. Asset recovery became a lengthy international effort. Legal cases continued through the early 1990s. Courts reviewed evidence concerning fraudulent loans and concealed losses. Investigators also examined the role of affiliated companies used by the bank. Some entities had been created specifically to support internal financial transfers. The legal proceedings aimed to establish accountability for these practices. However, the complexity of the bank's operations created challenges for prosecutors. Responsibility was distributed across many individuals and institutions. This distribution complicated efforts to assign individual liability. Some executives avoided prosecution due to jurisdictional limits. Others faced civil penalties rather than criminal convictions. Legal settlements resolved certain cases involving financial misconduct. Regulators also reviewed the role of external auditors and supervisors. Questions arose about how the bank had avoided detection for so long. Public inquiries examined weaknesses in regulatory oversight. The legal process demonstrated the difficulty of prosecuting multinational financial fraud. Courts can impose penalties and recover assets after collapse. However, legal action typically occurs long after financial damage has occurred. The collapse of BCCI in 1991 revealed structural weaknesses in international banking supervision. The bank had operated across 78 countries. Its structure placed different parts of the institution under separate regulators. No single authority monitored the entire organization. This fragmentation allowed the bank to expand while concealing financial risks. Jurisdictional boundaries limited the ability of supervisors to share information. Each regulator focused on the segment within its territory. Financial records were distributed across multiple subsidiaries. Internal transactions moved funds through several jurisdictions. These transfers obscured the true financial condition of the institution. Complex corporate structures made verification difficult. Auditors reviewing individual subsidiaries saw only partial financial activity. Regulators faced similar limitations. The bank's leadership used these divisions to sustain operations. Secrecy through offshore entities increased the opacity of the system. Political relationships discouraged aggressive investigation. Influential clients reinforced the bank's credibility in many markets. Depositors trusted the institution because it appeared globally established. The bank's reputation grew alongside its international network. However, the underlying financial system remained fragile. Hidden losses circulated through internal transactions. Regulators did not fully identify the scale of the exposure until coordination increased. Once investigators compared records across jurisdictions, the structure became clearer. Evidence of systemic fraud emerged from the combined data. The bank's collapse followed quickly after this coordination. The case demonstrated how financial institutions can exploit fragmented oversight. Global banking networks operate across legal boundaries. When regulation remains national, supervision becomes incomplete. Complex corporate structures can conceal risk for long periods. International cooperation becomes essential for effective oversight. After the collapse, regulators began reconsidering supervisory frameworks. Policy discussions emphasized stronger coordination between countries. Financial authorities recognized the importance of information sharing. Global banking supervision gradually evolved after the case. However, the underlying lesson remained structural. Banks operating internationally require equally international oversight mechanisms. Without coordinated supervision, risks can accumulate undetected. Financial complexity can conceal instability inside large institutions. Eventually, verification occurs through crisis rather than routine supervision. When authorities coordinate their information, hidden structures become visible. The BCCI case remains one of the largest banking frauds of the 20th century. It demonstrated how mobile financial structures can evade fragmented regulation. When oversight is divided, fraud becomes mobile.